Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Deepak, mutual funds have a reputation for being this salaried middle class kind of product. The thinking is that you earn a monthly salary, you set up these SIPs or hopefully a bunch of SIPs, they leave without your noticing. So there's kind of a forced savings that happens before you get around to spending your money. Since the SIPs are automatic, when the market falls, they'll still invest. So you get the benefit of averaging in and buying perhaps at a lower cost. Whereas if it was a discretionary decision, you may have panicked and stopped. And I think this is certainly all well and good, and it's done really well for so many people. But the more I think about it, mutual funds are actually just a vehicle, right? I mean, they're just an instrument to invest in an underlying asset class with many benefits. So what puzzles me is, why do mutual funds only seem to be targeted or marketed towards the middle class or the salaried middle class? When I go around meeting family offices, no one ever tells me proudly, hey, I've bought 5 crores of some quant mutual fund, or I have 10% of my portfolio in Parag Parikh or whatever. That's not the conversation you ever have. They seem to do other stuff, direct equities, privates, and so on. So I think the question I'm bringing to you is, are mutual funds only sahi hai for the salaried middle class, or is this a product that makes sense for more people?
Yeah, Shray, the problem with the positioning of the middle class as the target for mutual funds has been, it's not just related to India. It's even in the US, when in 1940 or 1930 or something, when Merrill Lynch actually put a front page advertisement saying, please invest in mutual funds. It was considered an exclusive product till then, and it was only available for the relatively rich. People were like, oh, if everybody can invest in this, is this really for me? That kind of a feeling. And it's really that something, that sentiment that you're echoing in the part of things, which people say it's not, exclusive enough, and it's for the masses. And perhaps there are two things that we want to do here. First, we divide India into, say, economic, kind of categories. So there's 1 crore people in India according to income tax data, about 1 crore people make 10 lakhs or more per year. So that's about,
And so household size of 4, it would be about 4 crore people.
Effective, family size, 4 crore effective people. 6 crore make between 2 and 10 lakh rupees per year. So that's about 25 crores of India B, if you may, India A, India B, India C. And the reason I'm saying A, B, and C is because no letter is better than the other. It's just that, I'm just arranging them alphabetically. But the C is probably the rest. They're farmers and have an income but don't need to pay income tax, or they're relatively under, paid, or are in the lower economic strata. Now, the mutual funds in general are considered, now the way you position it is, if it's available for everyone. And the person is also looking at this and saying, well, I want to increase my economic status at some point. And I want to reflect my increased economic status in the things I do, the things I buy. And I'm going to perceive myself as saying, if something is not exclusive to my economic class or the economic class I want to be in, I don't want to be seen using it. So in the sense of even the India A, the top 1 crore of people, there's an India A plus, if you may, and that A plus is probably thinking of, oh, dude, I'm going to earn 25 or 30 lakh rupees per year. This is about 15 lakh people who have declared this kind of income, perhaps maybe a little more than that. But this is the number of people or number of households who can afford the BMWs and who can afford the richer, the more expensive hotels and restaurants and all that. And because they can, there's now a perception of, well, if they can afford it, it must be higher quality. So, for instance, if I go to a restaurant, I'm thinking, if I go to a McDonald's, the McDonald's is for the masses. You may not like its food, but it's the same food that you get everywhere. So you can be sure that that's what you'll get. Or you may like it, and this thing. So, but it's not considered to be the highest quality for two reasons. One, A, everyone can access it, and B, it's not very expensive. The same thing if you go to Lupa in Bangalore, or if you go to a Taj or an Oberoi, you're thinking now it's expensive. So because it's expensive, it costs a lot, and therefore they must be using the best quality ingredients, which can't be used by somebody else, and so on. So therefore, I'm actually getting perception of higher quality because I'm paying a higher price. Mutual funds, since they are relatively cheap compared to some of the other options you mentioned, you're thinking, well, it's cheap and then it's accessible to everyone. Your thought process goes towards, oh well, it must not be the highest quality, and therefore it doesn't come back to my economic class. It does not reflect my economic status if I only have mutual funds. This perception is perhaps a little weird, because I think of this as, look at mobile service, mobile telephony. This is a place where about 20 years ago, maybe, people would look at mobile telephony as part of their fashion statement or economic statements. They were saying that, oh, well, you know what, I should walk around with these pagers and mobile phones on my belt. Therefore, I have the smallest mobile phone. Where you can't, I'm now old enough to say that big is good. So it's like, you couldn't see the damn thing, you could hold it in your palm of your hand. That was considered to be, class. But something changed. And that something was perhaps Reliance Jio in that sense. But the scale at which people are now being able to access telephony, two things. First, that it's cheap. It's very cheap in India to get mobile, telephony working for you. The second thing is that it is the same quality, bad or good, accessible to almost everybody. So if I buy a plan today, earlier it used to be like, oh, you could get a faster plan if you paid more money. You're getting the same speed for the most, but everything's limited by data. What they figured out is that, listen, if you do a large initial investment and we buy the spectrum and towers and this and that, then it doesn't matter that I can serve a lot of people with the same bandwidth, the same quality. It doesn't matter if you're rich or poor, you get the same quality. You might choose to pay more for more data because the amount of data that flows in the network costs me money on an incremental basis, but incrementally it doesn't cost me to serve you at a higher speed versus a lower speed. In fact, in many cases, I have to, if I try to sell you something at a low speed, I have to set devices to control your speed as a telephony person than to say that everybody gets the same speed. So it's effectively cheaper for me to offer everybody the same quality, and therefore it's cheaper for you. I can make it cheaper for you to access it. Everybody has a mobile phone today. And I don't think the rich people think of it as saying, I won't use a mobile phone because it's not exclusive to me, or I'll only use a satellite phone from now on. Because we don't somehow see that argument there. But we do see this the feeling of the mobile. I think the mutual funds are more like the mobile phones than they are of the hotels.
Well, let's stay with your mobile phones things very briefly. But we're talking about mobile phone service. Isn't Airtel considered more higher end than Jio, or postpaid? Because of its postpaid customers, it's considered a slightly higher status or a slightly higher quality product than a Jio product.
It's a great. I think I've had a mobile phone since 1996 or something like that, and up till 2012, I used to have a postpaid product. And the postpaid idea was that, you pay the end of the month, and you get a bill and you pay certain amount per month. Prepaid was a concept that was considered to be for the poorer people who would pay a smaller amount and maybe 20 days at a time or 30 days at a time or 60 days at a time. But when I moved to Bangalore in 2012, I realized I don't have a permanent address yet. I was looking for a house to stay in. And then I said, I need a phone. So I went to Airtel and I bought myself a prepaid connection. Very quickly, it became evident to me that prepaid has exactly the same quality at 50% of the price. So today I pay roughly 3,000 or 3,500 a year for unlimited data, 1.5 gig a day, or not unlimited calls, 1.5 gigabytes a day, blah blah blah, and the cost is about 300 rupees a month, including GST. GST is about 18%. So it's about 250 a month if you don't do this. But I just pay upfront for the whole year. Now, this is ridiculous, because if I went for the same postpaid plan of a similar type, I would pay 600 plus GST per month for the most part. And then you'd have a bunch of things where after a while I started to realize that all the services I can get in a postpaid, I get in prepaid. I get it at a lower price. I get it at the same quality. And I can prepay for a year and not have to worry about it. I have 5 mobile phones today. which are 3,000 SIMs. So five things are bought for the family, and the whole bill is less than 2 months of my family bill that used to be before this. So I used to pay 2,000 or 3,000 rupees a month at some point per SIM before I shifted to this postpaid. So it is ridiculously cheap and the same quality. So think of this as, oh my God, what I mean, is my perception of postpaid being better just wrong? And when I call someone, they can't tell whether it's postpaid or prepaid. So there is no perception difference at all from that perspective.
Well, that's a fascinating digression on postpaid versus prepaid, and I'll be curious to check if that still holds or whether the numbers are now just so low that you've stopped noticing. But let's bring this back to mutual funds then. Looking at mutual funds, how do you bring the same quality, same product for everyone logic to mutual funds? How would you expand on that?
Yeah, so the interestingly, the way that you do it in telecom is to buy all the spectrum, put all the towers in place, and once you realize how spectrum works, you just have to use it. Unused spectrum is a waste of time. It's the same as unused electricity. You produce electricity and you don't use it, it's gone. The electricity has to be used the exact minute it is produced or exact microsecond that it's produced, because otherwise there's no point about it, right? So you storing electricity actually costs a lot of money. So if I store it in a battery and then I have to use that battery to power things, the transmission losses and the losses in this whole process are so huge that you just don't want to deal with it. So you produce it and use it. So you spend a lot of upfront investment, and you know that once you've spent that upfront investment, every minute that any part of this thing is unused, it's a waste of a resource. A fund management industry runs on people who can manage funds, a fund manager, some technology spend that you do in a bunch of things to make sure that technology allows it to be accessible for a lot of people. And then you've got the fund, licensing and setup and compliance and architecture around that. All of this costs money. Once you set it up, it doesn't matter how much or how many people access this service. You can give me 1 rupee or you can give me 1,000 rupees. And as long as I have a way to invest a pool of money, a number of people in that pool don't matter. It doesn't cost me incrementally any money to get more people into this pool. Now, if it did, I would say there was a problem. And for instance, if you told me, can I not do a 1 rupee SIP? The answer is no, because it cost me more than 1 rupee just to get you in. So if it cost me 2 rupees to get you in, my minimums will be 500 rupees, because I'm saying, 0.4% I can spend in order to get you in. But the minute you make my minimum 100 rupees, now I'm thinking, shit, I have to pay 2% just to get his payment into my system, and therefore the incremental cost increases. But at 500 rupees, you have a very large population. India, A, B, C, A+, everybody can invest because it's 500 rupees at a time. And it costs me very little to get more people in. The incremental cost for a restaurant is very high, because I'm going to have to buy high quality ingredients and so on. But for me as a mutual fund or for me as a telecom provider, the incremental cost is very, very low to serve an additional customer. Therefore, it makes a lot of sense for a mutual fund to be thought of as a mobile service effective product, where you have a large investment that has very little incremental cost, versus something that is more related towards high quality in terms of restaurants, or high quality in terms of cars or anything like that. The overall structure of a product in terms of perception of quality should be divorced from price in these industries where incremental cost of service is very low. I can provide the highest quality service or the same quality service to everybody at a much, much lower price, simply because I have upfront investment in these products.
So, Deepak, this is a compelling enough argument, and I get it. But the fact of the matter is that every time I've spoken to, say, a wealth manager, someone working at a family office, a principal at a family office over the last year, our conversations steer towards things like whether they maybe got Swiggy pre-IPO, whether they're currently getting access to Zepto or not, stuff like that. So mutual funds almost just taken for granted. So however compelling your logic may be, the fact of the matter is that people are looking at other asset classes, other instruments that very much are not available to people at a lower economic spectrum. How do you then justify your argument in the face of this?
Yeah, so I think there is part of it that I must accept. for instance, there's a good economic pleasure, perhaps, or not economic, but maybe just whether it's vicarious or otherwise, it is just good pleasure to buy something that you feel is exclusive, it's nice, it's perceived of great quality. So, for instance, I could always argue that a Birkin bag is not functionally superior than a Chinese knockoff. But you're not buying the Chinese knockoff just because you want you feel much better because you like the brand. Now, this is the same thing. I would say there's a perceived inequality in investment products, and that perceived inequality does lead to pleasure in certain circumstances. Like you said, if I've invested early in Swiggy and Swiggy goes IPO, I feel like somehow I have achieved something, and I've achieved something that not many other people could have achieved, because it was maybe an economic status thing, it was maybe because I was in at the right time, but somehow that gives me that pleasure of being able to do that, and I say that's a good thing. In
or
the sense of,
you use it 5 times a day and you're like, I'm so glad this exists.
So glad, so I'm somehow making money for myself. So, in that sense. But at some level, you have to look at it from a rational aspect as well, saying that this is perhaps not the best use of all your money. Now, and I say it very carefully, because it doesn't mean that I say don't do these investments, but I say don't exclusively do these investments because they are useful for a different reason. But there are problems in some of these exotic products because they are sold to you with a promise that sometimes even they can't keep. For instance, you might say that Swiggy was a great idea, but there are a bunch of other companies that are unlisted. It could be a Zepto, it could be something else, it could be a bunch of other companies that you buy a piece of. Maybe you go through a VC fund to buy a piece of. And what you don't realize is suddenly that this whole investment is illiquid. So you might be thinking this is part of your net worth because of X. And suddenly that X simply doesn't exist because, that something happened and somebody served a GST notice of 1,500 crores on some company and you didn't know what to do and that company has to shut down. Suddenly you're like, oh, well, I invested all this money and there's no getting out, because there's no getting out at like 30% lower. There's 100% loss or nothing because there's no liquidity in the product. If you don't want to buy it, almost nobody else wants to buy it, because by nature it's exclusive. The number of people that actually could afford to buy such a product are less. They're all aware of the problems that are happening and therefore nobody wants to buy a product. So your liquidity is zero. The risks are different because in a public company you have disclosures, you have this, you have that. So so equity investments through mutual funds have almost a guaranteed liquidity phenomenon. They might invest in illiquid companies, but they also invest in liquid companies. So since you're a pool, if you take out your money, they can choose to sell the liquid investments and pay you off. Of course, if there's a run on the mutual fund, that's a different thing. But I'm just saying that by and large, this part of it does have a simplified version of access to mutual funds are a simplified version of access to products that are effectively liquid. But what happens is you have a term called volatility laundering.
So, on this, before you get to that, I was saying the fact is that maybe the reason people, not all my money is going to be in mutual funds, right? Even if I'm completely sold on what you're saying. But maybe the thing is I can get uncorrelated returns or diversified returns, or I will participate in building a company that I may one day feel very proud or happy that it exists. So how do you deal with that? And we can of course start with volatility.
But I'll come back to volatility because I'll address this point from a diversification perspective. It's a great thing to diversify, but you have to remember something. You diversify because you get returns from different parts of the investment universe in different times. The investment universe, unfortunately, is correlated when there is a crisis. That means bonds will go down at the same time and gold will go down at the same time and stocks will go down at the same time when there's a serious enough crisis. And when there's no crisis, they could be inversely correlated for short periods of time. But you will also notice that at times when you need the money, perhaps, and perhaps this is a problem that we are seeing more now. If you need the money, the liquid instrument that you buy is the one that has to go first, simply because the illiquid ones are by definition you're not able to cash it at the right time. So what happens is you have mutual funds which are liquid. You have a bunch of other things that are illiquid. Now the mutual funds could be doing fantastically for you. Like they could be giving you 25% returns. This other thing sounds like it's great, but when you do the calculations, it's doing 15% returns. You want money, you're going to go to the one that is liquid. right? You're not going to be able to get out of this one that is illiquid because it's simply illiquid by definition. And then when it gives you money, you kind of feel happy that it's given you money because it's kind of locked in your money for so many years. The volatility laundering part of things is both of these things are marked to market every time. So they give you a valuation. They might say, oh, you know what? You have 100 rupees in mutual funds and 150 rupees in unlisted company shares. What does that mean? That means nothing. It means somebody perhaps paid 150 rupees for a share that you also own. It does not mean that if you went to somebody and tried to sell that share, that you would get 150 rupees for it. It means it's marked to someone else's price, not to the price you would get. So it's marked to imagination in that sense, right? So you're actually giving me a return that is not real. So, oh, I invested 50, it's become 150. Can you sell it for 150? No, I can't sell it for anything. It's worth 0 if I try to sell it. But it's worth 150 because somebody else paid 150. So in that sense, it's volatility laundering because two instruments are being compared on returns and one instrument is super liquid and the other instrument is not. And, you could say, for instance, this entire crisis that angel investors say that, there was a war, President Trump put all these tariffs, but none of my companies fell because I have invested in private companies. But you know what? They're going to make losses next year or perhaps even go out of business. Then you'll have to recognize it. But till then.
Is this what, say, the Harvard endowment or endowments in the US are also facing with their private holdings right now?
Yeah, this is interesting because this is, so the endowment is basically the alumni putting in money to say, well, the school will use this money and then invest it somewhere.
And there's a lot of it.
This significant amounts. I mean, I didn't realize that the money is so much. But we're talking billions and billions and billions of dollars.
I think Harvard itself is north of 50.
Yes, north of 50 billion. And somewhere, I think Yale was this original school of thought where they said we should diversify away from government bonds and start investing in other things.
And public equities also.
Equity. They did public equity first and then they did private equity, where they would invest in VC funds and PE funds, which are illiquid by definition. And now many of these things are 90% of their portfolio. But here's the problem. It's not 90% of their portfolio when they go to sell it. That means if they think they have $90 billion in private and $10 billion in public, that doesn't mean that if they took the $90 billion in private to sell, they would get 90 billion. In fact, what they're finding out is they'll get only 45 billion because the people on the other side of the table are like, oh, wait, you're desperate to sell. And why are you desperate to sell? Because Harvard has been just told or had been told, at least for a brief period of time, that the government would not fund it anymore. So they needed to generate some cash. So they were using the endowment to say, let's get some cash out of the system. So they went to try and value their private entities, the ones that they own. And they suddenly found that in many cases they would only get 50% of the investment back because the way the structure is and all that. So the problem is you thought you had 90 billion plus 10. So you had 100 billion. You actually have 45 billion plus 10. So you don't have 10% in equities, you have 20% in public equities. But guess what? Because you can't take that loss. And in your mind, it say that if I waited 5 more years, that 45 billion is possibly going to become 90 or 70 or 60 or something like that. You take the 10 billion out of the table. You take the public equity out of your table first. So mutual funds become this, in that sense, because they're more publicly accessible, the easiest instrument to sell when you need money. And which is also one of those things that make them inferior in people's minds, because if you don't value a product so as to keep it in spite of its performance, then it has lower value to you in your own head, saying, oh, I can sell this anytime I want.
Okay. Let me try and counter you by saying sometimes liquidity is a bit of an illusion. I completely understand and acknowledge the argument when it comes to your private investments. I think most of us are sensitive to this by now. But the fact is, let's say Harvard, to use them as example, had $50 billion in public equities. Not all $50 billion would be in the Mag 7, right? There would be some small caps here and there, which are not doing particularly well right now. Won't they face the same problem when you as a large seller, or if you own a lot of a company and go to sell? This happens in India all the time. I think when promoters try to sell, it's viewed as a signal of weakness, or there's simply just not enough appetite in the market. How do you counter that?
Oh, this is absolutely true. In fact, I think this is a problem with mutual funds also, and it's a problem in the equity universe in general, is that liquidity is an illusion because at times when you really need that liquidity, if the market is down, you're not going to get it. There are lots of very interesting ways that people counter this in more markets where there is some normalcy. I'll tell you where it comes. I'll give you an example of situations where when you have large quantities of shares to sell, very like endowments and things like that. Even mutual funds, if they have very large quantities of shares to sell, the possibilities remains that there's in the market there could be enough. There could not be enough buyers to be able to sell the stock, and the stock could go lower circuit, and therefore you don't make your money out and all that. But the pooled vehicle concept, we addressed it at some point, is that the pooled vehicle concept helps you in certain cases where the pool has a combination of liquid and illiquid instruments. So because everybody assumes that only about 10 to 20% of their people will exit at any time, they keep 20 to 20% of the money available in liquid securities that allows normal operations to continue. But in a crisis, of course, all of this goes to hell. I'll give you another example. If you have a company that you want to sell, but you're such a big player that if you try to sell it, the price would tank maybe 70-75%. One of the recent examples is a company owned by Sumitomo and Isuzu, which is SML Isuzu Limited, listed company in the markets. They have decided to sell their stake, which is about 60% of that company. It's not a huge company, but still, to M&M at 40% of the market price.
Oh.
So the market price was 1,650. They're selling to M&M at 650. So you're like, why? Yeah. But because, if you don't have Sumitomo and Isuzu in this company, who's going to run it? Obviously, the technology and all that stuff, they make school buses, they make, vehicles like that. Now, obviously, you'd have to sell it to somebody. Now, that somebody is looking at you and saying, listen, if you guys want to sell, you can dump your shares in the market. But if you dump it in the market, the stock price is going to go 90%. Because you are 60% of the company's ownership, and there's not enough buyers of your company in the market. So they're almost looking at this and saying, listen, this guy is giving me 40% straight on. And because that 40% comes with a caveat, every time if M&M buys that 60% from you, it has to offer the remaining 40% shareholders to buy at least 26% out of that 40%. That means they have to only leave 40. They have to say, listen, I'm going to buy your shares at a public offer. That public offer price is determined by the market price of that company, which is 1,600 rupees. Now, this is not a very expensive company, but still the price is negotiated by SML and Sumitomo and Isuzu is 40%. So they weren't able to liquidate. So if they thought their share was worth 1,650 into their 40, 50, 60% of the company, they could have written this on their balance sheet saying, oh, well, you know what, this is what it's worth. But when they actually went to sell it, there's nothing left, right? So it's like government owns 49% of Vodafone because of all of the stuff that it does. But can it value that 49% as 49% of the 72,000 crore market cap of Vodafone? No, because if the government went and said, I'm going to sell this 49%, the share would fall by 90%. So they would not get 10% of that. So it's like, in a way, this mark-to-market concept at very large stake ownerships, when you're the elephant in the room in that sense, has no value in that. So you're right in that, when you have these situations where you need liquidity, it depends on whether you're the elephant in the room or not. So if you're a really rich person and you own a significant percentage of a company, it is not as much worth as the market price says. The same thing would apply even more in a complicated way to the illiquid other instruments, where you're saying, listen, I know I own this instrument, but it's not really that much. It's like if I paid 10 lakh rupees for a diamond, if I sell it, the chances are I won't get 10 lakhs. They're very big chances. In fact, somebody did a big survey on this at some point. They said, are diamonds sellable for the value that you buy them at? There are very few diamonds where, especially the big ones, where even the buyer will buy them, the seller will buy them back for even 50% of the value that they sold it to you at. Simply put, these things don't have a value. Diamonds are forever bought because they should not be sold.
One idea that comes to mind is if you have a challenge when it comes to, say, liquidity, can't you just take loans against your assets and use those loans to fund whatever short-term requirement you have and then pay them back once the market recovers?
Yeah, this is in fact one of the things that people keep making jokes about as well, saying that, oh, well, you may have illiquid investments, somebody will give you a loan against them, right? And then they're liquid, you're able to convert them into cash in some way. Possibly true, because what has Elon Musk done? He's borrowed money against his Tesla ownership and gone and bought X or Twitter, or and changed it to whatever it is. So I think, yes, you could do that, but many places can't take loans because of two reasons. One is they don't want to, and B is they're not allowed to. Harvard, for instance, as an endowment is like, dude, why are you taking loans when we have given you money to go and invest in other places? I mean, it doesn't make sense. So the organization may not be allowed to take loans in the first place. The same thing in a lot of places in India. If I am a VC invested company, I don't want to have loans in that company, because the VC may say, listen, if the minute you take a loan from a bank or anything like that loan will therefore, the directors will get, whatever on lien for that loan. In case there's a fraud of some sort, the directors get impacted. So I don't want that to happen. Therefore, I don't want you to take any loans of any sort. So yes, they could take a loan, and perhaps it is a very efficient way to work through a liquid instrument because of taxation. And we haven't come to this, but one of the biggest elements that happen that differentiate a mutual fund from most other investments is taxation as well. But however, before that, let's go to this point, and we'll say this, that the reason why taxation makes a difference is, if I sold an investment today, I would immediately be taxed on it. If I took a loan against it, I would not be taxed on it. I would just pay the interest. Sometimes the interest cost versus the incremental gain I can make by not paying the tax, the interest is cheaper to pay. So therefore, you might choose this loan mechanism to pay for stuff. But like I said, I don't think it's available for everybody to be able to take a loan, and definitely not in something that is very liquid. So people were willing to take a loan on Tesla shares, which is what Elon Musk did, because Tesla shares are public. But if he goes and tries to pledge his X shares today, it may not be as easily liquidatable, because the guy who's giving the loan is saying, if you default, can I sell whatever you've given me as collateral? So that also becomes a big bit of a problem that way.
Since you've brought up Elon Musk, let me go back to VCs with SpaceX as an example. Couple of years ago, and even recently, people have been on offer with SpaceX shares. And I think with the way the rules work in India, it's not as difficult for you to be able to invest, say, into SpaceX shares as it might be to open a brokerage account abroad at some point. So given that, I keep thinking that maybe the problem is you just need to find the right either companies or the right VCs, and private investments can still make enormous amounts of money. If you're very bearish on, say, India, saying that maybe the outcomes here aren't big enough, at least in the US, there seem to be VCs who have made incredible amounts of money for their investors.
Some only very few have. And if you look at even the Harvard endowment result, their private equity investments, although some of them have been spectacular, some of those have been not so great, they haven't turned out that great for a lot of reasons. Now, one of the problems in the VC world, and perhaps in the investment world, is the way we classify returns. So if I told you that I've made 4x return in 10 years, you're looking at me and saying, wow, that's nice. So if I give you 1 crore, you made it 4 crores in 10 years. But that corresponds to a 14% return, which has been met by even the Nifty in the last, or most mutual funds in the last, equity mutual funds in the last 10 years. So then thinking, then if it's not even meet a mutual fund return, then is it really a great return? But that's the problem. So what happens in the VC world is, in 10 years, if I have to return you, take your 1 crore and make you 4 crores out of it. And I know that I'll be charging you 2% per year. So 2 lakhs per year into 10 years. So 20 lakhs I have to keep aside. So I have only 80 lakhs left to invest. That 80 lakhs has to give me 4 crores for you to make a mutual fund return of 14%. That means I have to do 5x to breathe. To be alive in this room, I have to make 5x. And I know that I'm going to invest in maybe 20 or 30 companies. In those 20 or 30 companies, few of them are going to give me this massive 30x return or 50x return. And the rest of them are going to be ordinary. If 10% of my portfolio or 1% of my portfolio gives me a 50x return, to give you an example, that's still half my fund. right? I need to make 4x my fund. So if I've invested a certain amount in a company, I need it to be meaningful enough for it to, or that return. So this 50x sounds great on the book. I owned Swiggy and it gave me this fantastic return. Yes, but what's the overall return on your portfolio? Oh, well, that's about 14-15%. Because a lot of companies have lost. And you think of it as a VC fund. What happens is, and maybe you know this better, the VC fund gives you money back when they make profits. These profits are yours to be taxed. So they make these successful exits maybe 6 years in, maybe 7 years in. And then you're like, suddenly, oh, I got, you know what? I gave you X and you made me 50x on this company and 20x on that company. They're all the winners. The losers haven't yet come. The losers are going to be given this full 10 years and maybe another 2-year extension. And then you're going to have to write them off. So when you get the money, you pay the tax. When you lose the money, you don't pay, you get the tax benefit, as in you get a loss. But you already paid the tax on the profits. So now you have to invest in the next VC fund in order to just offset the losses that you've had to make because you invested in a VC fund in the first place. So it's a little bit of a structure of both. So then it's not like you should invest in one VC fund. Maybe you should invest in 5. And then suddenly now you're thinking, wait, if I'm investing in 5 VC funds, I don't have any money left for mutual funds.
I'll add one more sort of like caveat to that. I had the good fortune of speaking to some incredibly successful VCs in the US, both through relatives and so on. And I think the point was, I mean, if you want to think of it very carefully, the idea was you should probably invest with a VC fund across multiple vintages to make sure you're getting, like, one can be a little luckier than the other, so one could end up being unlucky. So I thought that was something worth noting. But then I realized that each one would be a couple of years. So this could be like a 10-year journey along with one investment. And this may not be something that I have the patience or the capital for to be able to go.
It's great to have so much capital that you don't have to worry about it for the next 15 or 16 years or 20 years. But typically, if I asked you also, if you had this much money and you want to give some of it for 20 years away to, say, a VC fund, you would say, well, I won't give all of it. I'm going to give you like 10% of it. I'll give you 15% of it. I'm not going to give you like 100% of it for sure. So this is something that I think because of that, I mean, it's just a way to think about, you get the exotic product, but it has these exotic disadvantages that nobody talks about. It's like, oh, I own this. You hear this a lot, even by the way, from the middle class. I own this property, which is a piece of land in the boondocks of somewhere. But about 15 years later, there'll be a metro station there. And then the property will increase. So even that person is saying, listen, in my mind, this property is there, but it's kind of written off. If it actually works out, that's great. But if it doesn't work out, then you know what, it's not a significant part of my portfolio. You rarely ever find a person who says, I've taken all my money and bought this land in this desert. And one day there will be sunshine. And there will be, grass and greenery around that place. And then we will sell this, So very rarely do you find such things. So because of that, I think great from a asset diversification point of view. But because of these disadvantages, they necessarily have to be a smaller part of your portfolio. And perhaps the large part of your portfolio ends up becoming more liquid than otherwise.
Fair. And I think to add an example for a volatility laundering thing, it's like you insisting that your house is still worth, say, 2 crores or 3 crores, even though your neighbor has sold an identical house for 1.5 crores recently on the market because that person was distressed. But when you have to do it, you'll get the fair price.
Yeah, so I think we do have a perception, a different kind of a perception for assets we like versus assets. For instance, gold goes up. Everybody loves it. When gold goes down, nobody hates it. They say it will go up. So because you love the asset, it doesn't matter whether it's gone up or down. You're going to be on the defensive side of it anyways. In the stock market, sometimes you have to agree that the stock market itself is volatile. So there will be times when life sucks. There will be times when life is great. But you know that in the end of all of this, some companies will outshine the others. So you can't fall in love with a company, but you can make great returns overall in the market, right, with the diversification. Maybe that is how the structure goes in mutual funds, and perhaps that's how the structure should be in private investments as well.
Sure. So I think maybe enough about non-public stuff. Let's now go back to public equities. Let's stay with all public equities. when it comes to investing my money in shares and stocks, how do mutual funds stack up against AIFs, PMSs, just doing it directly? Where do you stand on that?
So you know what, the AIF, and this is as me being fascinated because we have an AIF, we have a PMS, and we've just got a mutual fund license. So why am I saying mutual funds are in that sense? I don't think they're necessarily great. I'll tell you why. There are very good things about AIFs and PMS. PMSs also invest in public stocks. AIF Cat 3 invests in public stocks. So it's not like they're better or worse. You could get much better PMS fund managers than mutual fund managers. The mutual fund manager, because they're they have larger corpuses. Those corpuses may actually not be commensurate with investing in the really tiny stocks, which might have a lot more capacity to grow. So the PMS guy could go and invest in these 100 crore market cap, 200 crore market cap company, which a mutual fund simply cannot touch. And then that 100 crore market cap company can become a 10,000 crore market cap company. So you get 100x return, except you weren't able to get in because you were in a mutual fund, whereas a PMS person could have gotten in. So I think there is that structural advantage that PMSs have and AIFs have as well. The structural disadvantage is taxation. And we've seen this in our own PMS. One of the problems of the PMS world is that everybody pays taxes the minute the fund manager sells or if the fund receives a dividend, because these are individual accounts. So even the AIF is a trust. The trust receives dividends, it has to pay 40% tax, 39% actually. But this taxation disadvantage is so structural because the mutual fund does not have the similar disadvantage. A mutual fund can buy, a mutual fund can sell, there's no tax. The mutual fund can receive dividend, interest, any other thing. There is no taxation at all. So given this taxation advantage, I think mutual funds can do an amazing or incredible job in terms of delivering great post-tax returns for a certain investment style. The disadvantages of a mutual fund are simply that they are so big that they cannot attract into size, and there are restrictions. So for instance, a mutual fund cannot invest more than 10% into a company. But if I do want to, I do have a very convincing idea. I can do this in a PMS. I can say 40% of customers' funds are invested in one company, and that company could really become big. The same thing I could say for some of the other elements of it also. For instance, if it's a 100 crore company, a mutual fund house as a whole cannot own more than 10 crores of it. So it could have 5 funds. Each of the funds can own 2 crores each, but they can't own more than 10 crores of the company as a whole, because that would make them more than 10% holders of any individual company. This creates problems because in some cases I want to invest 20 crores. The promoter says, listen, I want you to invest 20 crores in this company because I'm going to take that 20 crores and make this company 5x from here. But less than 20 crores, it doesn't make sense. So what happens is the mutual fund then has to find another mutual fund house or something like that to kind of put in this money. And usually they won't participate. It's too high a percentage for them to participate. And then, but the same thing a PMS can or an AIF can, and most often do as well. They buy the most riskier credit, because mutual funds, when there's risky credit, because there have been some credit issues in the market recently, people have exited them in en masse. And you have to provide them 1-day liquidity or 2-day liquidity in debt funds. So therefore, people don't like to invest in credit risk in mutual funds. So these products actually have an advantage. But in the longer term, the mutual fund taxation advantage is so large that a PMS has to make roughly 2% more per year just to offset the taxation advantage, and then give you further alpha on top of that. So if you, and plus in the PMS and an AIF, sometimes, not with us, we don't charge in the PMS performance fee at all. But if you pay a performance fee, the net return comes down by that much again. So it's not just Nifty plus 2%, it is Nifty plus 2% plus the effect of the performance fee and so on, which is then therefore at some point disadvantage for PMS or an AIF. So it's a little bit of a structural thing, but I don't think this is necessarily a reason for you to not invest in these. If they remove the liquidity problem, they introduce a taxation problem. So the mutual fund has both liquidity and taxation as a benefit. The only disadvantage for the mutual fund in that sense is its lack of exclusivity, and nobody gives you an IPL ticket to buy a mutual fund anymore.
Let me talk about large sums of money. Let's say that there's a family, they have wealth, they have 100 crores. If you invest in a mutual fund and you're doing active equity strategies, you could end up paying the fund managers indirectly, of course, something like 1 crore a year on that. That's a fairly significant amount of money. Can't you perhaps hire 1 or 2 people to run it for you with that?
Wow, this is, in fact, this is great because you think 100 crores is enough of a money to be saying, listen, I should be able to hire a fund manager. It cost me 50 lakhs. Instead of paying 1 crore to a mutual fund, why don't I just get a person to... Now, your issue is this. Firstly, if this person comes in, you're going to hire this person. You're going to have to hire the right kind of person to run it. And then this person will need a team because at some point, they can't just operate like 50 lakhs me individually. Maybe they'll need 1 or 2 people beyond this because you need reporting, you need this, you need that. So there's infrastructure cost for doing so. The second thing is you have to motivate this person to stay because at some point they're thinking this is your 100 crores. Why can't I get another 100 crores from somebody else and then do the same 1% fee and become a PMS by myself, become an AF by myself? And, because they're growing. And then you're probably looking at them and saying 100 crores. No, I need 20 crores to invest in Swiggy tomorrow. So you're like, wait, I just did this fantastic investment. It's better than Swiggy. No, we're going to do this. So at some point, you have this motivation problem that 100 crore AUM does not solve. So you're rich, but you're not rich enough is what I'm trying to say here in that sense. Because if you take this problem to 500 crores, then you're suddenly talking real money, right? So at this point, you're saying, oh, well, wait, if I go to a mutual fund, I'm talking 5 crores per year. Now, that is a lot of money to pay. And if I go through a bank or a wealth manager, maybe another 5 crores to them because they might be charging commissions or charging me a management fee or something like that. The minute I get into this larger sums of money, I start thinking. And usually at this point, it's a family that has this kind of money. And this family will have younger people who've gone and done their education and all that stuff. One of them will probably come in and take over and say, listen, I'll build up a family office. In this family office, we will try to reduce our effective cost and increase so I might still choose mutual funds. I might choose a different form. For instance, I might say, listen, it doesn't make sense to have 500 crores entirely in public equities. So I might say 100 crore directly in equities. About 100 crore in debt through mutual funds because they're still more tax efficient. Another 200 or 300 crore through equity mutual funds, and maybe a little bit here and there for the playing games and putting exotic investments in place and all that stuff. So the idea over here then becomes that the management makes sense once you get to that 400-500 crore thing. But this hiring a person, and unfortunately, I've seen too many people burnt by this, that you hire a young, bright person and then they don't have a career growth path because that's what it is. That's what they're managing, the family money. And they're not associated with the family themselves. They're not a family member. So it becomes all the more difficult for them to justify themselves staying in this organizational setup for too long. And the minute they get enough experience, they're almost like, give me a larger fund to work with, give me a more diversified fund to work with, and so on. And then they leave. So you do find now that somebody is trying to address this problem with these multi-family office combinations, which can, I think, in the long term be a little something, but it's sad perhaps, and I'm saying this with almost a tinge of regret, that it almost takes 500 crores to justify someone setting up a family office by themselves.
No, that's now a very rarefied and select audience who probably have enough people coming and talking to them. So I hear you on that. But as you were talking, 2 things came to mind. I think one place where mutual funds shine and one place where they don't. I think one place where they really shine is when you get, say, debt type investments. The tax benefits there, if you're able to hold on for, say, 2 years, are extraordinary, right? You're literally turning slab rates into long-term capital gain rates or something like that, I guess, or at least capital gain rates.
Yeah. So, in fact,
or not anymore, perhaps. With
well, there is actually, it's a very interesting combination. So, what's happened is it's been a fight, right? The mutual fund debt investment was considered to be a regular capital gain. So, after a year, it was taxed at capital gains rates, which were long-term capital gains for debt funds, were I think 10 or 20% or something like that. So it was much cheaper than having a fixed deposit. So the banks went to the government and said, excuse me, why are you doing this? This is the fixed deposit people who are putting their money into debt mutual funds. So now debt mutual funds are taxed forever on all income at slab rates. That means if you sold a debt fund even 10 years down the line, you would still pay slab rate on the income you make in this fund. But I will still say that is superior, because while you buy an FD, every year you get returns, and every year that FD, my mother has a bunch of FDs, every year she gets, say, on say a crore of FDs, she'll get about 8 lakhs rupees of interest. That 8 lakhs comes with a tax bill, and because she has some other income, she ends up paying maybe 10 or 15% on that money, and that money is gone. That 10-15% is gone. It's only the remaining that she can use or reinvest. And then the reinvestment of a lower amount of money has compounding effects in the long term, right? So just the fact that your interest receipts are not taxed if the money is sitting in a mutual fund is a benefit by itself. But now they have even more complicated things. So the government said, okay, what is a debt fund? If you're 65% in debt, you're a debt fund. They slowly changed this to, we'll create a new class, a debt fund, an equity fund. An equity fund is 65% equity. Debt fund is 65% debt. Then what if you're none of the above? You're less than 65% in debt, but you're also less than 65% in equity. Oh, we'll call that non-debt, non-equity. This has a long-term capital gains tax of 12.5% after 2 years. So this non-debt, non-equity class is a kind of a cop-out, because it allows a gold fund to be taxed only at 12.5% after 2 years. But guess what it also does? It allows people like the mutual fund industry, and I'm saying this because we're going to be part of this industry, or we are part of this industry, and now, but we also understand that our customers want to save as much tax as possible. So we create a fund which is 60% debt. But you're thinking, wait, the remaining 40% is equity. I don't want that much risk. No. We'll do equity arbitrage. Equity arbitrage is when I buy a stock and sell a future. So technically there's no upside or downside risk. They balance each other out. I just make the difference in the middle. That could be 6%, that could be 8% or something like that. But since 40% is arbitrage and 60% is debt, this fund becomes 2 years 12.5% capital gain tax. Now, paying 12.5% for an HNI is much better than paying 39% the same money in a pure debt fund or a fixed deposit. Or, in fact, it is like this. I need to get 12% in interest to counter a similar investment which is taxed at a much lower rate, which gives me only 8% or 9% in yields. Because in one case I pay 40%, in the case where I am investing only in a debt fund or a fixed deposit, but here I'm paying only 12.5. So that differential, and everybody wants a little debt in their portfolio. That the idea is to diversify away from an asset class perspective, but also to provide for liquidity. I need money 6 months down the line. My son is going to the US. I am going to use the money and put it into a fund. I use arbitrage funds myself, but somebody could use this combination fund as well. If you need money 3 years down the line to pay for your house, you're not going to try and risk it in equity, because 3 years is 3 years is borderline where it could get up or down. At 5 years, I think you're better off in equity. But these 3 years, you're going to want to keep this money significantly in debt. So you could use a mutual fund. Also because the debt market doesn't even want to talk to you unless you bring in 5 crores per ticket. And even an HNI may not have that much money, because if I have to buy 20 investments, I have to have 100 crores. You're like, wait, 100 crores is gone and just 20 investments. Now what? So if I have 40 crores, I can't participate. I shouldn't participate. Mutual fund is a better route.
Okay. One thing I think mutual funds do poorly, there's a whole lot of these business cycle or opportunistic funds. And I think the problem there is by the time they've launched, the trend is probably already over or is on the way out, and you end up basically investing post fact. How do you deal with that?
Yeah, that's an interesting point. I think this is like, at any point you find this in any new fad brings in new people who kind of sell you that fad. If it was crypto, there would be suddenly crypto exchanges advertising on the IPL. Today it is some poker and some Dream 11 and something like that. So it's a fad. Maybe a lot of people are doing things that attract people's one side or whatever that is and all that. And I think over a period of time, you learn from dealing with fads that there are fads. They are fads in that sense. My first investment was in the mutual fund industry, was a technology fund bought in the peak of the dot-com cycle, almost timing it to a point where from then on the industry saw a down cycle for 5 years. So literally I was the peak. But I was not just sold that. Everything in the world was buying, everybody else in the world was trying to buy that, both in India and the US. This was 2000 in February. So in that sense, yeah, there are these facts. And so in that sense, the way wealth managers perhaps make things very interesting is that they say that this is great and you'll be the one getting in, and you'll be the one getting in early, and therefore you'll make a lot of money. Or look at so many people making money from this. This is another product that is perhaps sold in that vein, and it has its uses, because sometimes some people are like, listen, I don't want to invest directly into hospitals because I don't know how to figure out which hospital is better. Can you get me a mutual fund manager that wants to buy hospitals? So this is a genuine demand at one level, but sometimes the thematic becomes like just a fad. Oh, India is fighting a war, let's go buy defense companies. India is doing this. So then it's like, oh, if this product makes sense only when India is fighting a war, what happens if India stops fighting the war? Should I be exiting this fund? And then will this fund exist? Because it's supposed to be sold only for that. So the thematic has a problem. And I think at a certain level, at the risk of being a part of the industry and saying it, sometimes we do go overboard in terms of offering a lot of products that just confuses a customer. It's that initial scene of You've Got Mail. This guy, he talks about choices. You have everything, nothing is just coffee anymore. It's either low fat or high cream or low sugar or something, or black or double shot, triple shot, espresso versus cappuccino versus something else. So you don't call it, I just want to have a cup of coffee. You have to specify all these things because it makes you feel important that you're making all these little choices and decisions and therefore making the perfect set of coffee for yourself. Perhaps maybe that's what the mutual fund industry is also offering. So where instead of calling it coffee, we are making cappuccinos and lattes and low fat and high foam and whatever cappuccinos. And, in that sense, adding more to our menu cards than perhaps the customer is actually wants. But the customer actually feels happy that he has a fatter menu card to choose from.
Achha, let's go to the applicability of mutual funds to other people. One segment of the population, we've only been going up the economic ladder. Let's go a little lower down, that India C or 2 or 3 or whatever you called it. We've had actually very poor results with trying to get people working in our office, household staff, or people who are not really in your middle income category trying to invest in mutual funds. Even when we've tried, like you've tried to set up accounts with them, you've invested in say only GSEC funds or some simple debt funds with the hope that every day the number will be higher than the previous day and the person will feel the motivation to stay on. It just doesn't seem to work out very well. So have mutual funds failed basically everyone who's not above a certain income threshold?
This is, this is sad, but I think mutual funds have become very interesting from that perspective. I'll tell you why. One of the reasons that the people in the lower economic strata have different problems is two things. And I think one is just of what I would call ijjat or reputation or the feeling of being treated fairly. If you go to a bank and if you are what you are, which is, or when you go wearing decent clothes, talking English and all that stuff, you're going to be treated very differently from a person of a lower economic strata who comes there and perhaps has the same level of cluelessness as you do when you walk into the bank, simply because of the perception of the bank staff that this person is poor and therefore we should not waste our time on this person. Even if they have money to invest, even if that little money that they have can be invested properly, the amount of time they will take to get a fixed deposit is 4x the amount of time we will take, and 4x the effort as well. At a certain point, nobody wants this. So people stop going to banks, saying, listen, I don't want this bank bullshit. So what do? They go to a chit fund, where somebody at the same economic level or strata is coming to their house, talking to them nicely, taking their money in cash, investing it in a chit fund. The returns are also not bad. For the most part, chit funds return fairly decent amount of returns. And these chits are used as both lending opportunities, investing opportunities and borrowing opportunities. Because you know that if I keep investing in this product, at some point I can take a loan from it, and that loan will therefore be used to meet my demands at any point in time. Now you have something similar. You can buy an FD, you can take a loan against it if you want. You can buy yourself a mutual fund and do this. But the FD industry has kind of shot itself in the foot in some way, simply by having people who are the lower economic strata feel very, very concerned about having to deal with banks for their investments. They're already dealing with banks for their transactions, but deal with banks at the investment level has some kind of an issue. Mutual funds have tried to democratize this in a different way. They've said, listen, the whole thing is electronic now. You don't need to open an account with anybody. You don't have to meet any human being. You can do this entirely on an app, take your photo and give your PAN card entirely on an app. You don't have to worry about anything. It'll all be done. And you can invest on a regular basis, take out money on a regular basis. It'll come back to your bank account. This has changed this social problem that we have created by having classes and economic stratas, by saying this is all electronic. It doesn't matter who you are, you can invest. And you could do this with stocks as well. But the difference in stocks is that it takes one more layer of decision making to figure out how many stocks to buy, which stocks to buy and all that stuff. But I think the mutual fund is a more simple way to do things in general. I find this fascinating because from a perspective of even the poorer people, this is a great way to save for a long-term goal. And the long-term goals may have a different number to it, a rupee number to it. The down payment for a house, the taking of a house on a lease, and all of these things have impacts that can make meaningful differences to their lives at much different value. So you might say, for me, it doesn't make any difference until I reach, say, 50 lakhs. For somebody else, it may be 5 lakhs, or it may be 1 lakh or 2 lakhs. But sometimes the regulatory requirements tend to stymie them. And one of the reasons why I think this is the problem is, I invest in a mutual fund today and I keep investing in it. 2 years later, they tell me you have to do KYC again. Then you're like, listen, I did my KYC. I did it one time. No, we have to do it again. And now you have to produce these pieces of information. And you're like, no, but last time I didn't have to give all this. No, we have some new requirement. So you have to keep doing this every 2 years. And then if it doesn't happen, if it doesn't work, you have to go meet a bank person. You have to meet a mutual fund person, which again brings me back to, oh, you're going to treat me shabbily again. I don't want to do it. Or if you're going to make me spend half a day sitting at the bank just to do something like this, I don't want. So I think that is a problem that we've got to solve, to remove maybe a KYC requirement at some level for people who are less than 5 lakh rupees in total. That they shouldn't have to do this stuff all over again, all over the time. You can enforce it more for people who have larger sums of money. Now, of course, I don't mean to say that KYC is not important, but I do mean to say here that sometimes these requirements hurt the very people whom we want to bring into the industry because it's so much more efficient than anything else.
Deepak, there's a whole other segment, corporates or startups. Basically, any company, they often have either profits lying around or funding they've raised. Mutual funds should make some difference to them. But one thing we've noticed is startups that even when they raise large amounts of money, they struggle with investing in mutual funds because of that RBI 50-50 rule, where if they're early in their revenue growth, they can't really invest. And then there's also a question of, are you taking equity risk or some non-risk startup risk with the money we've given you, and the VCs or the investors don't want that?
Let me just elaborate on the 50-50 rule that you said, Shray. RBI has a rule that says if you have 50% of your assets and 50% of your income, both of them, coming from a financial source, and technically, therefore, investing in stock markets, investing in mutual funds of any sort is all financial income, then you should be classified as an NBFC. The problem with this rule is that, let's say you're a new company that's raised capital and it's raised maybe 10 crores. It doesn't expect to use this 10 crores all at a sudden. You have a new company, all your assets are in your head, your brain, your code, your software. You don't have meaningful income because the first year you're just building the software. So you kick this 10 crores, you put it into a mutual fund. That mutual fund gives you 8%. This is a debt mutual fund. And you got 8%. So you take that 8%, you don't have any income. So all your income is this 8 lakhs that's come from the financial source. and you don't have any assets. So most of your assets are this money itself. So suddenly now you're an NBFC, and NBFC has no lower limit. This could be even, I could have this problem even with 10 lakh rupees. Now you have to write to RBI and say, sir, I have been told that I may be an NBFC, but I'm not an NBFC. Please allow me an exemption. And RBI is going to look at this letter and say, why are we even talking to this person? Because this is not obviously a problem that we have. It is their own money that they're investing in mutual funds. But they can't tell you because the rule actually says 50-50. They're going to say, well, send me a balance sheet next year and hopefully you'll have more income next year from other sources. And you'll fail to, but technically you're in violation. So this is a problem. So what happens now is that they conveniently call a fixed deposit not financial income. So you can invest in a fixed deposit and that would not be classified as financial income. I'm like, why? How is that any different from anything else? But no. If you've invested in a mutual fund and you've withdrawn the money, that is financial income. So yeah, this is a bit of a problem. We need to solve this by removing perhaps the definition of 50-50 or changing the definition of 50-50 to something more meaningful. Maybe it should be 80-80 or something like that, which would then make more meaningful sense as a financial concept. But because of this, a lot of corporates have idle money that they just keep in fixed deposits. Fixed deposits are not the most convenient one in terms of taxation or in terms of returns. Today, RBI keeps cutting its rates on fixed deposits, on repo, and then banks then reduce their fixed deposit rates. When they reduce their fixed deposit rates, everybody else gets lower returns, and these corporates need to do something. But if you have other sources of income and then this money is just a fringe amount that's lying around, you have this problem that, say, a large company that you've built a great company now is generating cash. You can take out the cash by giving it to the shareholders as a dividend, and you're one of the shareholders. But you're thinking, you know what, if I get dividends, the company is already paid tax. Then I get 100 rupees as dividend, I have to give 39% of it to the government back as tax. So I get to keep only 61 of every 100 rupees that is distributed. That doesn't sound fair because the company has already paid tax on this money before it came to me. So guess what? I will not take dividends. Let me take the 100 and invest it in the company itself without its paying dividends in the first place. This changes perception because then the company needs to be the one making that investment. The company can make this investment now in equity or in debt or in a hybrid or in the format of that, one of those things which is more tax efficient. I would say that is a better use of that money for the company, even if it were to get 12.5%, because you're compounding the money before tax. And one of the problems with taxation is you can't predict what taxation will be tomorrow. Today I may be taxed at 39%. Tomorrow I may be taxed at 25% because the government reduces personal income tax to that level. Or that there could be a tax break because I've got some other investment which I have a big offset on and I can offset it using this income. So it's better to defer taxes always than to pay them upfront and then use the remaining money, right? So it's I think the idea should be to grow the money there. So corporates who are either cash rich because they've generated profits or because they've got VC investments, all of them should invest or consider investing using mutual funds because it's the simplest and cleanest approach. Even in an FD, if I were to break an FD, I will get a lower interest rate for the period that I invested in. So I could have a 10 crore FD. And I'll say, listen, every time I need money, I'll just break the FD. So let's say you broke 5 crores out of it in the course of a year. The process of breaking the FD is like this. You don't get full interest for that period. So you might have contracted the rate at 8%. But they say, listen, you took out this much 1 crore in a month. For that 1 crore, we will not give you 8% for the month. We will give you a penalty of 1%. So we'll give you 7%. And then we won't even give you that 7%. We will give you whatever rate there was for 1 month at the time you took the FD. So when you started the FD, the 1 month rates were 5%. Then you will get that 5% minus 1% penalty, so you get only 4%. So technically, your returns keep coming down if you take out the money. Take the same thing in liquid fund, where in just a liquid fund which gives you 7%. If you take out money in the middle, whatever you've earned the income on, that much is not affected. There's no penalty of any sort. There's no change in interest rates of any sort for that time period. So corporate would actually do better if it was invested in a liquid fund compared to an FD. Some corporates want to do equity investment. Like I said, they don't want to take out the money. They want to grow the money in the company before they do this. And the last bit is, I can tell you an FD is a great investment. But then you might say, oh, Deepak, I'm getting a better FD rate at Karnataka Bank. Great, let's set up an account there. As a corporate, you're thinking, if I have to do this, I need another board resolution for Karnataka Bank with multiple signatories. And then some other bank offers a better return, I need another board resolution. In a mutual fund world, you buy one mutual fund, then you can shift to another mutual fund without having to do all this board resolution nonsense again. It just works as it is. So you'll save yourself some procedural trouble as well. And because it's liquid and you can control the risk of these investments, you can invest in the least risky and to the most risky at your convenience without having to shift too much. Remember also that this NBFC problem applies only to companies, not to LLPs. So an LLP can have almost all its investments without having to worry about an NBFC rule, at least as of the time we speak, because things could change right tomorrow. But this 50-50 rule does not apply to LLPs. So you could use an investing strategy in LLP as well, where you might have extra money lying around and that LLP is no longer useful or functional. That money could still be invested through mutual funds in a different way. I just say that it's a very good and simple approach without having to worry, because a mutual fund, like you said, is a vehicle. It's not the asset class. I can't say a mutual fund is only for equity. It's could be for equity, it could be for debt, it could be for both, it could be for gold, it could be for a combination of all of this and international equity and so on. So you can choose your asset class, you can choose your risk, you can choose your investing style and then invest. So for a corporate, it makes sense to say, well, you know what, I don't want risk, I want liquidity in 1 day's notice, I want better taxation. You got a product.
Okay. Just one caveat. I think they brought down the highest tax rate on dividends from that 39 to 36 or something like that. So this is slightly better.
Yes.
And the other one is, I think I would personally get very alarmed if the company I'm investing in has an enormous balance sheet on which it's investing in stocks itself. Be like, where's the attention going? I mean, at some point.
You're right. In fact, there are many companies, listed companies now in the stock exchange, which have more money in the companies that they've invested in than the regular business has in any meaningful form. We call them holding companies. Some of them were designed to be holding companies. Some of them just sort of became holding companies by accident because they held a bunch of shares and then suddenly that share has gone up like crazy. Their core business is doing nothing. So the value of their investments is greater than the value of the cash that they hold. It does happen in some cases where you have a bank or actually a set of companies where the underlying holding of, say, a real estate is so huge that you realize it only after this company decides to sell that real estate, that, oh, there was this value in the company as well. So, we've seen a bunch of stocks like that recently as well. So, but it's not uncommon, and unfortunately, it is a problem if you have the promoters of a company more worried about the stocks they're investing in rather than anything else. But like you said, the problem, I think, is concentrated in companies where the rest of the business was not growing or not meant to grow at all. Anyway, this is all the business that is left.
Fair. I'm winding down, so I'll get to the last three questions. The first one is a bit of how would you use mutual funds for these use cases? So how would you use mutual funds to save, plan, invest for retirement?
Retirement, I think is a great point, because I think people get to understand what retirement actually means in terms of cost after they're in their 30s. And that gives you about maybe 25 to 30 years to invest. And if you start off investing in something, your problem is that you want to take the maximum risk when you have a lot of time. So I want to investing in equity and this thing and a bunch of things. The more I take this risk, the more, let's say, my corpus grows over a period of time. I do an SIP, I invest in all that stuff. The mutual fund can be used to just say, oh, I'm going to buy an equity mutual fund at this point. But as you come closer and closer towards your retirement, you're like, listen, I've got all this money and the market can fall 30% tomorrow. Now, 30% of this massive amount of money. So today, for instance, if you wanted to retire just now and you want to spend 1 lakh rupees a month for another 30 years, and this 1 lakh rupees a month needs to grow by 5% every year to make up for inflation, then I need a corpus of roughly 4 crore rupees, 3.6 to 4 crore rupees. Now, if I have 3.6 crore sitting in equity, a 20% fall is a 72 lakh rupee fall. I don't want to see that hit. So obviously, I don't want the money to be all in equity because I'm going to retire 2 years from now or 1 year from now. So I'm going to have to start moving it to debt. So one way to do this is this SIP that you have is mostly equity towards the beginning, and later you do an SIP into a debt fund. Or you could buy yourself a combination product, which is hybrid. Remember though that every time you do something like this, there is a tax that needs to be paid if you sell an equity fund and buy a debt fund. So there is a taxation component that you have to think about, but you do have to do this balancing somewhere and use this as a mechanism to save for a certain fund. I hope in the end India creates a retirement account like we talked about called a MERA, which is, we did another podcast on it. But the MERA concept is that there is no intermediate taxation if you balance out the products before you retire. But after you retire, the entire thing is taxed as income. Until we have such a product, you have to assume there's a taxation disadvantage to doing this. But or you could buy just a hybrid product that says, well, you know what, I'll be 60% equity all my life. Even when you retire, you don't want to be 0% equity. You want to be maybe 20 or 30% equity, and then slowly change your asset mix on a daily basis, on a yearly basis or something like that. But mutual funds actually give you a mechanism to do this by using a combination of SIPs in different funds. We did this in the PMS, and I think targeting retirement with the fund with the concept like this, it's not very difficult to imagine that this is the product that you want to build. And then slowly adjust yourself over a period of time.
I think one other part of the using mutual funds for retirement that is a bit understated is they're really tax efficient, or can be very tax efficient when you do your withdrawals, because of the way the unit math works, that you're selling a lot of capital and less gain and so on for any given amount of money.
Yeah, this is actually great for, so for instance, a lot of people tell me that, Deepak, what do I do if I got a big lump sum, but I want to use this money to make income for myself? Now, what's the biggest choice? Now, my mother does this with FDs. She's got this, let's say she's got 1 crore, she puts it into an FD, she gets 8 lakh rupees per year that she can spend on this. Problem is the entire 8 lakhs is taxed for her. I mean, of course, if that was her only income today, it would not be taxed because up to 12 lakhs is no taxation. But since she has other forms of income, it is taxed for her. Now, whether she uses it or not, it is taxed. What I tell people is, listen, find out how much money you need. Put your corpus into a debt fund or, a combination fund or any of these things of any sort. What happens is, let's say you did this hybrid product that I talked about, 60% debt, 40% arbitrage. It's just a hybrid product that is tax efficient after 2 years. But for the first 2 years, you're thinking it's still going to be badly taxed. But no, let's say you put 1 crore in it, you get 8%, you get 8 lakhs. Now, you've made 8%, so that 1 crore has grown to 1 crore and 8 lakhs, right? So, the way the government sees it is, when you sell the 8 lakhs, you actually had sold something whose capital purchase value was 7.4, and the remaining 60,000 is the 8% profit you made on it. So your gain is only 60,000 rupees. So you pay tax on 60,000 instead of paying tax on 8 lakhs. 8 lakhs at 20% is 1.6 lakhs of taxes. 60,000 at 20% is about 1,200 rupees of taxes. So it is literally 100x lesser tax in the first year. In the second year, because now you made 8 plus 8, 16%, you will again take out another 8 lakhs, where they'll say, well, you know what, the government will say 6.5 lakhs is your investment, the remaining is your profit. So your profit is only 1.5 lakhs. You've taken out 8. You've taken out all your gains, but you're taxed only on 1.6 lakhs out of this. It takes roughly 10 years to reach a point where your taxation is equivalent to an FD. But after 2 years, if you bought one of these combination products, your tax rate automatically falls to 12.5%. So it's a very efficient way to do systematic withdrawal with much lower incremental taxation than a fixed deposit, with the same liquidity profile of a fixed deposit. That means you can take it out whenever you want, you can take a loan on it, you can do whatever you want with it. But It does not have the tax disadvantage of the FD. There's only one problem. The debt markets and the arbitrage markets are not linear. There are times when you will find a little squiggle down. That little squiggle down can hurt you mentally. I was worth 100 rupees yesterday. Why am I worth 99 rupees today? If this hurts you mentally, then it's a problem. Then you cannot have a debt fund as a product. But if there is no problem in a little squiggle once in a while, then I think you should consider having these products.
Using mutual funds for your kids' education, I guess college education or something like that.
Personal story, I started investing in the PMS like this, and I think the story applies both to PMSs and mutual funds if you do it the right way. Is that I started targeting a certain amount of money that I thought he will go to a college in India. So I used Indian college framework. Today, I have grown it to a point where he can attend college abroad as well without because I've been able to invest more money in the time frame. All I did was invest in the PMS in an equity and debt fund combination. And over a period of time, I've gotten it to a point where there's about 75% equity in that product and about 25% debt. The 25% debt allows me to pay for his first year's college fees through the debt component. Then next year, I will take out some more money from equity and put it into debt and allow that to grow and so on. So it's been something that I've tracked along the way. At every point in time, I knew where I had to be and I knew where I was. So I was just trying to make up the difference each time. And I think I wrote a blog post about this as well, and we'll probably link it in the show notes, is that the idea is that simply you stay on track for by just doing adjustments along your path, as long as you know where you have to be and you do this. You could do this with a mutual fund as well. I did with the PMS, but the PMS exposes itself to me as a mutual fund. So it has an NAV on a daily basis, and I can see how much goals are being done. In a mutual fund, you can use folios. That's the interesting part, because let's say I have 2 kids. Am I going to invest in different mutual funds for each one because I have to track their goals? You don't have to. So it turns out that mutual funds have folios. So you can actually go to a mutual fund and say, I want one folio for my elder son and one folio for my younger son. I can invest in SIP into each folio differently. Yeah, I mean, each of them are different growth path. One's going to go to college 5 years from now. One is ready for college. So I might have to put different amounts into equity, different amounts into debt. So I track each one's progress the same, but I invest into the same underlying mutual fund. So I don't have to actually go and say. So in the PMS, we actually even this out by saying you don't have to worry about investing in different PMSs or different portfolios. It can be the same portfolio. We'll just classify them into 2 different goals, we call them. The mutual fund industry uses folios. So you could create a folio as a different goal and then each track the goal independently by itself. Some end software like MFU and a few things allow you to even specify which fund is for which goal. But you can track these independently and do this. I think it's a very useful way because it really helped me last year, because I got lucky because I was able to move out of equity into debt just about when the markets were at their peak. I think that's just lucky. But I had to do it. It was not because the markets went up also, I would have been the same amount of happy or sad. Because I'd be like, you know what, I had to move that money into debt regardless. But it gave me the ability to say, I will stay invested in equity as long as I can. And then when I get closer to my goal, I'll just move the money into equity, into debt.
My last question. We've spent this episode pretty much extolling the virtues of mutual funds and whatever, and it's a pretty strong use case. Who are mutual funds not for? Who is the type of person? Is there anyone after this discussion with all these virtues listed who a mutual fund doesn't make sense for? And adding this, supposing you come into maybe you sell your stake in Capital Mind, or you get some huge exit and you end up with hundreds of crores or 500 crores as the example we gave in that. Will you be doing mutual funds yourself, or will you be managing stocks because you're a good stock picker?
Very interesting. Very interesting. Let's start with the first part. Who is it not for? I think mutual funds are definitely not for a few people who do not like the concept of risk at all. Like my mother doesn't. She's very happy with fixed deposits. It is not for her, for sure. I tell her that, listen, you can try it, but try it as a flavor. not as the main course. So the main course should be FDs for her. There are other people for whom FDs are legally not allowed. For one example is, for instance, if you're an NGO that receives funds in FCRA or something like that, that NGO apparently, if you receive a fund, you cannot invest in any asset that diminishes in value. So it cannot invest in anything other than FD. So legally it's not allowed. There are at least in this area, maybe 5 kilometers around here, there are at least 500 apartment complexes. Each apartment complexes, they build a corpus. That corpus fund runs to crores of rupees. Most of this corpus fund sits in fixed deposits because the corpus rules or the fund association rules say we can't invest in mutual funds because they are afraid of any month when the value goes down. I think that is a problem, and that they might want to change things, but because the rules write it that way. Sorry.
No, I was going to add, I think it's not just one, I think one type of person it's not suited to is anyone who, when they see the value falling, is tempted to sell, or someone for whom the liquidity is a disadvantage because either people lean on them for money or their own life keeps presenting opportunities. Sometimes you're your own worst enemy.
Yes, in fact, let's just elaborate on that. One of the problems that I have with when poorer, not poorer, but generally people, when they have people around them who have financial constraints, those financial constraints compel them to ask, do you have any money? Can I borrow it from you? Now, if this person had gone and invested in a house, he's going to be like, I bought a house. I can't just sell it and give it to you. The guy's like, no, don't sell your house. Come on. That's nonsense. So they're not going to borrow from you if you buy an illiquid instrument. But if they say you have a mutual fund, oh, you have a mutual fund, just sell it and give it to me. No. And I'll give it back to you in 2 months. You can't even say no, because this mutual fund allows you to sell it wherever you want. So maybe we should create illiquid mutual funds for this purpose, but as long as we don't have that, and ELSS was one example, where if you invest in an ELSS, you can't get out in 3 years, right? So you have some illiquid products in the mutual fund industry, but by and large, the common format of mutual funds is not for such people. If you're sitting in a situation, and maybe we should address this by products, but I think this is one class of a person that you should. Another one is, like you said, and I've seen most people who have made a lot of money in real estate over 10 years of periods, where they're willing to wait through that crazy amount of time simply because they don't have to mark the market every day. They come into the stock market and suddenly they're seeing their values change every day, and they can't deal with it because they're not used to having so much volatility in their net worth. They're like, wait, I was worth 1 crore yesterday, now I'm worth 95 lakhs. Now I'm worth 90, I'm worth 80, I'm done, I can't do. But if you had marked your house to the market every day or so, you might have seen the value would have gone to even 60 and then come back up, and you won't care about that as much. So people who are not used to volatility, for them mutual funds is a disaster. And I think they're better off investing in whatever they are actually more comfortable with, which perhaps could be real estate, a combination of liquid assets and all that. The number of people it is not for has come down. So you might have said earlier it was not for poor people. Now it is. Earlier it was not for companies. Now it is. So now I think that is also changing the way India saves. India keeps talking about, RBI keeps talking about, not RBI, but banks. We are putting deposits with us. We're going to mutual funds. No. Mutual funds are demanding higher rates from deposits from you, and you are giving them 7.5%, while you are giving us only 6%. So I am going to the mutual fund and getting that 7.5% minus the 0.25% the mutual fund takes, 7.25% for myself, because you are offering higher rates to the mutual funds than compared to us. So don't blame me for changing my view and going to mutual funds. If you had offered me 7.5% upfront, I would be very happy to take it. But you don't, because you think that I am this guy with no leverage. But guess what? I do have leverage. I can move to a mutual fund. This is the changing India, I think. So therefore, people have moved a lot, but I think there are specific people for whom it should not be done. And one of the biggest problems is this. People take loans to invest in mutual funds. They do it because the market, they think, is in a momentum and a tear, and I pay 8% loan. Why should I give away 40% that I'm making in the market instead? This, ethically should not be done. I don't think you can force people not to do it, but I think this is a bad idea, because it always results in misery, if not 1 year from now, 2 years from now, because you'll never change that behavior.
my ending question. If you end up with the 500 crore number you said, at which point even financially you can hire a team, you've proven yourself to be a good stock picker / investor. In this world, would you be investing in direct stocks, or would you be running the first family office in India which only buys mutual funds and nothing else?
A good question. I could invest in stocks myself, of course, and then I could invest in a bunch of other things. But should I? The answer to this is, I think, if I had a lot of money, there is a certain amount of money I need to, kind of generate as cash flow, just so that I have a corpus that says, well, this is money that will just generate enough money to run my household and my travel and my holidays and stuff like that. So you're going to keep that separately. But what's the most tax efficient way to do it? Mutual funds. So arbitrage funds perhaps, or a combination of this debt fund that I talked about. Keep that, use the interest of that, use a systematic withdrawal plan in SWP to kind of run you're done. So that's great. Now the rest of it has only two uses in my head. First, I have to grow it. If I have nothing else to do in life, I will just keep it in mutual funds because they provide me liquidity at any given point in time. And like I said, the rest of it has, I could do the exotics, but these exotics have all these problems. They're not necessarily giving me greater returns. So, that part. There may be some stuff I'd give to charity. And I consider, to my head, if I'm investing in, if I were to choose to invest in startups, it won't be for the returns. So it will be the charity part of things. So it comes back, it doesn't come back, it doesn't come back. But that's a way to return money back to society. But it's not like an investing framework, right? But more importantly, what would I invest in? I would just invest through mutual funds simply because they're so tax efficient and provide liquidity, with the one caveat that I'm an entrepreneur at heart. And I would prefer to run my own business. And if I get my next big idea, I will look at it even financially and say, my own business is very attractive to me. And the reason I say my own is because I control it. Nobody else controls it. When I invest in other people's businesses, they control it. Right? Even if I invest in a mutual fund which invests in other people's businesses, effectively I have two people looking at something else, and that's not under my control. But if I'm running my own business, I have the ability to take 100 crores and make it, say, 10,000 crores or 20,000 crores, which I don't think a mutual fund can. But so with that caveat, I would say that I would prefer to invest in my business if I had it. And for cash flow, regardless of whether it was my own business or otherwise, for cash flow, I think the mutual funds are the best bet. But when you go beyond these two use cases, there is no better way to, I think, invest in markets than from a tax efficiency point of view and from a liquidity point of view than mutual funds. I know it makes me plain vanilla and boring, and perhaps, look at me, I am plain vanilla and boring, but maybe that's what it is. That's what makes me think that I have invested these things right.
Well, if and when you have the 500 crores, we'll come back and revisit this and see what you actually say then.
Thanks, Shray. I hope that happens soon.
Thanks, Deepak.
Well, thanks for listening. If you'd like to hear more episodes, then do visit capitalmind.in/podcast. And if you'd like to learn more about our investment products, then just visit capitalmind.in to find out about our portfolio management service, where we invest in stocks and mutual funds if you have more than 50 lakhs that you can allocate to us. Till next time.